Just Gold Digger Media.
All right, welcome in, boys and girls, wherever you are in this world. We wish you a happy day and hope things are going well. Let's get the business right out of the way here. This discussion is for educational purposes only and not financial advice in any way. Nothing shared here today is a recommendation to buy or sell any security. All investing involves risks, and you're responsible for your own decisions. Please do your own research and consult a licensed professional before acting upon anything heard today. With that said and that out of the way, we want to welcome our special guest, Cy. How are you today?
Doing great. You got me dancing with that snazzy opening music. Gets me excited.
An homage back to my 70s, you know.
Feels right.
You got one eye on NVIDIA earnings right now and one eye on us, or what?
I've got all my eyes on you. I'll catch up with that after. But since my options positions are off, I'll see what happens, and we'll pick it up tomorrow morning.
Yeah, I saw your option positions. We're going to take a look at them on TG. Well, I know they're all over them, but we're going to look specifically at TMGN. But you can talk about anything that you like today. We just really appreciate you spending some time with us. I know that your time is busy and you've got not only your business, but family and otherwise. So we are very grateful. Thank you. All right, so today you've been and you played most of the games. We're going to try a new one today, a different one today, and we're going to do this. We're going to do hot takes. You ever remember the guy named Jim Rome? He was a talking head on the radio and then on TV.
Oh, yeah, I remember. I remember Mr. Rome.
All right. So this is our version of it. We want you to have a hot take, and we don't want you to stink. All right.
Fair enough.
I'm gonna make a statement, and then you're gonna basically agree with it, tell us why, or disagree and tell us why. Are you ready?
Ready. Let's do it.
All right. Number one. Christmas decorations before Thanksgiving are unacceptable.
Oh, I totally disagree. Christmas decorations, as long as you can do it.
Yeah, I would leave them up all year long. So I'm with you. All right. Second, intelligent extraterrestrial life must certainly exist.
I mean, mathematically, it does. It has to. But it's not all about math. And then you start to get into theology and things like that. But the math nerd in me says it's got to be out there.
All right. So the engineer says yes. The other part, don't know, quite know, right?
Mm-hmm.
All right. Michael Jordan is better than LeBron James.
Yes, of course, Michael Jordan. I also grew up watching hoops in the 80s and 90s. So yeah, it's an era thing too.
Yeah, I think we all live by Jordan rules, even we don't want to accept it. All right. Bitcoin will eventually replace gold as the world's dominant store of value.
Oh man, do I have to choose? I'm sort of a classics guy. I'm watching things happen, but gold has been pumping, so I'm going to stick with gold right now.
All right. Well, that's the first one we're going to disagree on, but that works. Okay. Number 5, zero DTE options are one of the most misunderstood financial innovations of the last decade.
I mean, I would have to say yes, because a lot of the misunderstanding applies to use case, and you can use them in lots of different ways. So yeah, I think there is a big misunderstanding.
Okay. 6, humans will walk on Mars during your lifetime.
Yes, it's happening.
Oh, NVIDIA just dropped to 205.31.
Oof.
Yeah, we'll see. That's just the first move.
First move, you never know. Things digested over time, but I'm just glad to be out.
Yeah, exactly. All right, the last one before we get into it. The S&P 500 is no longer sufficiently diversified for investors.
I mean, if diversification is the measure, from a cap weighting perspective, it is very, very top heavy. So I think I would agree with that. But then over time, it depends on your conviction on what the markets are going to do. But you know what? That gets rebalanced over time too, because there's a committee that'll choose. So I think it's going to work itself out. S&P's been one heck of a bellwether, and I still believe in it.
Yeah, I mean, with the Mag 10, since we're going to get into that, they account for almost 38% of the S&P 500. And if and when SpaceX gets added in, that's going to breach over 40%. And so it kind of feels no longer is it like equal or something that really is diversified, but just my own opinion.
Love it.
So what I wanted to do is just kind of start as we always do with just kind of quick market overview. We get the chance to put a professional on the grill right here. So we want to take that opportunity. So just kind of your overview market. So first, I just want to say with all this, the supposed tariff wars with Canada announced, the declaring the Hormuz Strait as an American kind of like area, the Jackson Hole coming on Friday, the kind of like the today, I think they announced it was just a little hotter than they expected. What's your general feeling? What's your take right now? What are you thinking that you want to share with us retail investors?
Well, I think the other thing too is what's happening with the Treasury. So looking at the bond market and the new program that Bessent has announced is really interesting from just an optics perspective. And, he's trying to quell the bond market, but in doing so, it's like thou doth protest too much. There's a lot of worry now as to why this is happening. So I think that's one of the biggest risks out there. But there's so many variables that as these variables start to get checked and addressed one by one, I think we'll start to see additional upswing in the market. And you look at earnings, and we'll see what the numbers are with NVIDIA today, but like the Mag 10 earnings, the most recent, were lights out. And so businesses are doing well, earnings are growing, valuations are going up, but it's all of these geopolitical and sort of peripheral issues that are stacking up. So when each of these things kind of gets addressed over time, I think we're going to start to see additional rises in the market. But it's remarkable to see the resilience of what the markets have shown over the past, since the beginning of this year.
Yeah, it's almost like the markets are saying, or are implying, hey, I can't hear you through the noise of all the great earnings.
It's exactly right. And there's confidence that things will get resolved versus the day-to-day. And we've seen the volatility happen, especially with the war and Strait of Hormuz and the oil prices happening. But and the instability on, we've got a ceasefire, now we don't. So the markets are just kind of like yawning at that, which is, it's stunning to me given the geopolitical implications, but the resilience is there. And I think that's a powerful thing for the strength of the American economy.
And let's circle back to Bessent for a moment. Like him, don't like him, however you feel about him, he is being very active, meaning I think it'd be hard pressed to name the last 5 secretaries of the Treasury, but everybody kind of knows him because he's been very active. He's taken, I won't say taken the fight to the people, but he's at least put out what he's doing there. But announcing that he's going from $2 billion to $4 billion, that's such a drop in the bucket. It almost seems like it's a show as opposed to tangible efforts or something that he can really do something that makes a difference.
And, a lot of it, there's some saber rattling too. And there's discussion about, especially like the sanctions and the political and economical warfare kind of tools in the tool belt. But he is very active, and they're brandishing the things that they can brandish and put to work. But it just really depends on the impacts and the reactions geopolitically. But, time will tell. When they're flagging like, oh, we found $1 trillion sitting on the sidelines, that's a big signal to markets that will get people's attention. So time will tell over the next few weeks. But man, watching the muscles flex on what the U.S. has at its disposal has been really, what a remarkable time we're living in, good or bad politically. It's just incredible to watch and seeing how the markets are reacting.
Yeah, I guess I wasn't aware that we had $1 trillion slush fund somewhere.
No one was.
Let me go to my piggy bank and pull out $1 trillion, right?
Yeah, piece of cake, no problem. And then, then all the questions come up about, to your earlier question, what's the store of value going to be? Is it Bitcoin, gold? Because if you're starting to use that, especially, what's it going to do to the value of the dollar over time? And then everyone's looking at Japan with the carry trade. There's so many variables, it spins the mind, but the markets are having faith that we're going to figure these things out one thing at a time.
Yeah, and we just crossed 40 trillion, which brings to mind a quote that I saw. One of my good friends on X, Homie, posted up there. I want to give him credit for it. That basically said, Bitcoin has no top because the dollar has no bottom.
Write that down.
And with the $40 trillion debt, that kind of seems like, that at least in some wit, that statement might be true.
And we're seeing it actually kind of play out in real time with the path of Bitcoin over the last week or two and the bullishness there. But people are looking for good value stores that are going to weather this. I've always been long-term in my lens. So as far as like meaningful moves for myself, I'm sort of 10 years out sticking with the plan. But the short-term volatility is, it's really interesting to sort of be in the markets at this time.
Hey, last larger view question. What are you expecting out of, I always say his name wrong, Gersh? Is that Gersh? Am I saying that correctly? From Jackson Hole on Friday.
Oh, good question. Well, it's interesting because a lot of it has been less communications, not more. There's been good news and bad news on inflation, and that's going to be the biggest, I think, trigger for what happens with interest rates. So, you know, I just don't think we're going to get a lot of transparency. I think we're going to get a lot of, we're building a committee for that, we're building a group for that, and we're going to fight inflation, and that's our number one charge. But there's not going to be a lot of details as to how, and that's okay. We'll find out how the markets kind of manage that. But it's a very, very different regime than it was under our last Jerome Powell.
Yeah, I almost kind of expect him to step up to the podium and say, we're meeting. We're going to have tuna fish for lunch, and we'll be finished around 7 o'clock. Can I take any questions?
And the questions are, you know, the responses to the questions. I think the last press conference I watched for the Fed meeting, the press was a little bit befuddled because they're like, okay, you're telling me this, but you're not giving us any indications as to how this is going to happen. So that's where I think maybe some transparency and openness could help. That's always been a policy that I really appreciate, especially as somebody who's an active market participant. And it's also a policy we adopt as an ETF issuer, because the more you can share, the more people understand for decisions that they need to make.
Yeah, I think he's going to stick pretty close to the vest with what he said and basically not give forward guidance and basically say the markets are going to do what the markets are going to do. We're going to do what we're going to do separately, and where the two meet, let that just happen.
Right. Let the two sides do their dance.
All right. So let's circle back. The reason I invited you here is, if you can't tell, so far I am a big fan of TMGN for my own personal reasons here. And you've had about a month now. So I just wanted to kind of get your rundown on how it went, what the surprises were, what you found went really well, and then kind of give yourself a grade in month one.
I think the biggest surprise was a surprise to the good. One thing that you cannot backtest, especially in thinly traded options markets, is the liquidity that you can participate in, and like what are the quality of the fills that you get. So if you look at the options that we trade, and so for folks that aren't fully familiar with TMGN, we own 10 equities that comprise the Magnificent 10. And then we're trading one index option that sort of is collateralized by those 10 securities. The thing that we just did not have any real experience until you start actually pushing the buy button or the sell button is what sort of fills are you going to get. And if you look at the actual option chain, there just wasn't a lot of volume, and the spreads were bigger than you would hope. But we found, so the surprise to the good was we've been able to get excellent execution. And it's really funny now, because if you look at the chain, I think our fund is like 20 or 25% of the total options that are traded across puts and calls. And that's a big, you know, when you go into it, you're like, okay, that's a risk, because if you're getting in and you're getting out and you're doing it frequently, is there going to be a transaction cost to that? But we found a really phenomenal execution partner that has been helping us put our positions in. And so I'll give one example where part of our strategy is, you know, we sell the option in the morning. And then if the market's flat or going down, we have this scout that goes out and it's constantly scanning for maybe there's an opportunity for a second bite. So we do this with T-SPY and TDAC all the time, where we may close the position for 90, 95% of the gains, and then take a second opportunity if everything lines up to our standards from a risk reward perspective. I did not think there was any chance that we could apply that same capability to TMGN. But because of the execution quality, we've actually been able to do that a couple times, and today was exactly one opportunity to do so. So you'll see, you know, we opened at a higher strike, and then I think it was about midday, maybe 2.5, 3 hours left. We closed it and then opened a second position closer to the money for a total, you know, 2 bites at the apple. The reason we're able to do that is because the buy to close and the sell to opens are getting such good fill prices without, you know, having to be subject to super wide spreads, that it's still been profitable for us to do that. And that is just such a powerful tool in the tool belt to increase the premiums that we can get, because we can kind of like, the way I think about it is like, you can take some steps forward into the market where you can peer around a corner and say, all right, we have a safe position now. Oh, the market's improved. Now there's maybe another safe position for us to take, and to be able to trade that in a thinly, you know, a thinly traded option chain, I think is just a very, very unique capability to have. And that was one of the best surprises, because that can, you know, meaningfully increase premiums by maybe 10, 15, 20% on given days, depending on what the execution is that we get. So that was, I think, really, really pleasant surprise for us. This is the, you know, I won't necessarily grade myself. I think we're wading into this in a way to say, all right, we want to make sure that we're delivering growth plus income. And so the goal isn't the biggest distribution for us. The goal has been the best balance between growth plus income. And in order to, you know, you look at what's the underlying index doing from a performance perspective, and can we add something on top with the options component? And we've been able to do that across all the transactions that that we executed over, you know, since we started. And I'm going to jinx myself, but knock on wood. And I'm superstitious because I also understand, like, we don't have control over everything. so you'll see that for me. And I also was raised in an Indian household, and, you know, numerology and superstition is always part of it, which is, I'll explain why that impacts like our IPO prices. But to that end, we actually, all of our options positions that we've taken, I think there's been 30 positions we put on, not one of them yet has actually gone into the money and settled for a loss. So they've all ended up being additive without actually having to net out anything negative. So if I was going to grade myself on anything, I would say maybe we're not taking enough risk with the positions that we've had, because we're batting 1,000. And if you're batting 1,000, maybe you're not pushing it to a point where it's optimal. So we're wading into it, but I think that's maybe the thing for us to look at, is are we balanced enough with the, you know, the premium that's out there to collect, or are we being too conservative in the positions that we're taking?
All right, so a lot there. I want to kind of go back and unpack and get into a little more granular. Is that okay?
Yeah, please.
Okay, so first we talked about I won't say double dipping. I'm going to call it double dipping, but you basically, in the strategy today, you acted very much like a retail trader, like I would have if I had been trading futures or I was trading zero DTEs. You set out a trade in the morning, first thing I would say, it was basically a naked call, right? You didn't do a call spread. It was a call without a second leg, but I wouldn't call it naked, because it is fully collateralized by the underlying. You're 100% correct. I shouldn't have said that. In my mind, I'm thinking that's naked, but you're holding the underlying, so I completely get that. So you put a call out there, and it looks like your call was at 512, and that would have been based on your Fisher and your decision tree. Yep. And then somewhere later in the day, you looked at it and you said, okay, everybody's taking an NVIDIA nap. The market's not moving today. We can close this out at a large percentage of the profit and reset another one, because there's enough premium left at 509, because it was trading down around 503. Am I stating that correctly?
That's exactly right. That's exactly what we did around midday. And then we sort of saw, with the tools that we had, a second opportunity that had the right risk profile that said, okay, we could close this and then open this with the very, very high probability that we could get a second bite to increase the premiums that we've collected through the day. And we're able to do that midday because we've seen what the market has done so far, how much time is left, and how much premium is still left available to go harvest.
Okay. Now, so when you use the word we, Can you give us a little more other than like the generic French we, and let us know who that we is, because we don't want you to get hit by a bus. Can you kind of go through that for us? I know you've done it before, but just in case somebody's listening for the first time.
Yeah, so the we is actually, it's the team is growing. So the systems that I use end up helping us do strike selection. And then we have a team that does the trading sub-advisory. So like the person on point, which is me, the portfolio manager, pushes the button, and then that trade goes to multiple people, where we have a trading team now of, there's 13 traders that are in my communication channels that go and actually execute the trades. Then we have the compliance and oversight group. That's the Tuttle Capital group, where they're doing the checking to make sure that the trades are being executed right, and then that they're being communicated to the multiple parties that help us sort of implement the 40 Act wrapper around the strategy. And then we also have obviously backup PMs from that perspective of, if I'm not around, the system is available to help the other backup PMs do that. And whoever's on point, when they push the button, it's going to exercise that same group. But all in all, I think there's 16 people on the trading teams that actually can help pick up the ball if for some reason I'm not available.
And are you, because you have multiple funds, I think 5 now, are you looking at all of them yourself, or have you segmented, some responsibility out to others for different funds, or is it just you still?
Well, so we have multiple people with eyes on all funds, but here's the coolest thing about the tech is that if I didn't actually have the visibility and the dashboarding that I put in over the last probably 3 to 4 months, I would probably need a portfolio manager per fund. But because of the technology, because it's actually the same strategy implemented on top of different underlying exposures, it's really cool because you can actually see the same patterns applied to multiple funds. So we have scale to have one portfolio manager probably manage upwards of 5 core funds, and then the lift funds themselves are half managed by our partner companies as well. So right now, like, I'm the core one on point. The software actually does a lot of the triggering, and then there's multiple people that can watch those dashboards right now. So we've been able to scale really, really well, which is also why I think from a cost perspective, we're likely a little bit more affordable than some other ETF providers out there, is because we've been able to do things so efficiently.
Right. I don't want to stay here too long, but I do want to do 2 follow-ups there. Number one, price moves quickly when you're doing options, meaning it can be one place, 1 second next. It sounds like there's a few steps to place a trade. Do you ever, or have you made this efficient enough that you don't lose, that 7, 8, 9, 10, 12 cents that actually makes a difference in placing these trades when you see something that you like?
Yeah, for TMGN, it's been really powerful because our trading partner has a way. So like when we hit it and trigger it, they're on the other side and they have a bit of a range. And so they've been able to actually get fills done in a way that is, I think, fundamentally different than even some of our other funds. So like T-SPY and TDAC, they're participating in these massively traded entities. Like SPX is the most, traded option chain out there. NDX is a little less liquid, but you can get fills because of the notional value. But with MGTN, the fill process has been higher touch, but we've been able to do an excellent job in actually getting the fills on first swing versus actually having to go back and maybe like you miss it and then you start to get slippage in that way. So I've been really pleasantly pleased with how the execution team is doing.
Okay, and with that, are you trading, like if I was going to trade the CBOE Mag 10, are we trading the same thing, or are you trading flex options with market makers?
Same thing. That's the beauty of this, is it's actually an index traded option versus flex. And the biggest benefit of that is that because it's an index option, it is potentially tax efficient, 60% long-term, 40% short-term. So having the exchange traded version, I think, is really powerful for that reason. We could trade flex on Mag 10 right now, and they're kind of connected, but then you lose the tax efficiency because that just doesn't qualify as an index option.
Good to hear. Just in case anybody is, wanting to check it out on the sidelines, NVIDIA is trading right now at about 207.39, so kind of a nothing burger so far. Right. And then the last question in this segment, we'll move on to something else, is the people that you're talking about is Tuttle Capital, right?
Tuttle Capital they're our trading sub-advisor. And then there's another group that's our executing broker. And so the way our process works is, like the trade tickets, I was able to build in the direct path from our pricing engine and execution to actually sending a fixed ticket directly to our executing broker and to our trading sub-advisor. So both get notified simultaneously, which helps skip having an extra hop. So we really, like, from day one, the way I used to do it was we would manually send a notification to Tuttle, our trading sub-advisor, and then they would manually put that into Bloomberg, and then Bloomberg would send it to the executing broker, and the executing broker would execute it, and then it would roll back. Now all this stuff is happening in parallel. So we've really gotten better and better and better over time to streamline the process. And I think that's why some of our fills have been as good as they've been.
That's good news. So the next question would be the distribution was announced at basically 20. Hold on, I have it here. Well, I have the amount here was 41 cents or 41 or 42 basically cents, and I think the distribution amount was 20.90. Is this where you thought beforehand? Was it higher or lower than what you anticipated when you started?
It was like kind of right in the wheelhouse. So around 21%, between 20 and 22 was sort of the ballpark when we did the math. And we said, all right, we've got to look at this more broadly. It was like putting together a 4D puzzle, because you're trying to thread the needle between all these variables. And the variables that we're looking at are the one we talked about before, which is implied volatility. Is there enough juice to squeeze? 2, it is also, are you distributing more or less or right on point with what you think the sustainable distribution can be? And then the other dimension too is sort of the market environment. So if you look at income funds and growth plus income funds that are out there, there's a common trend that you'll see where peer funds that distribute 25% or more have generally experienced meaningful NAV erosion, depending on what the underlying's supporting it. The funds that have been distributing about 17% or less have generally done a better job preserving NAV, because you've got more support that you can provide over time. And there is like this desert in there between 18% and 24% that is very sparse for growth plus income funds that can deliver that sustainably and also at least hopefully have your NAV get supported and potentially grow over time. So we put all of that together to figure out what can we deliver and what's the best balanced approach. And our approach has never been let's be the highest headline NAV percentage, just because you could do 30%. And it's going to be a combination of the options. It's going to be a combination of the returns, of the capital growth returns. It's going to be a combination of the traditional dividends that come out. And the hope is you don't touch principal when you're doing those distributions. And so for us, we said, what is the best balanced growth plus income approach to take? And that's where we sort of landed in that 20 to 22% wheelhouse.
Okay, and with that said, you had more than the 1 month, 22 days worth of trading in this. So I'm going to make an assumption, and I know that always gets you in trouble, but assumption that you generated more income than what you distributed. First, am I accurate there? And then the second part of that question is, if you did, then the net amount between what the fund increased or your ETF increased and what the MAG 10 increased on the CBOE left about 26 cents. Would it be right to extrapolate that was the extra?
We do this from a total returns perspective. And the vehicle itself doesn't just have the option premium, it has capital growth. And you take what the market gives you. And the markets are going to do this. And our goal has always been my bad analogy of the peanut butter method, which is some months from the option side, you'll get a bigger lump of peanut butter. But you don't want to distribute all that in that same month, because maybe another month later, you won't actually have as much option premium available to distribute. So we want to spread that out in a way that we think is sustainable and hopefully will give us a consistent outcome. And that's the method. And there's 4 buckets where you can actually like modify the components that actually deliver what would net out to be hopefully a consistent income stream. So that's always been our method with our funds. And with the first month, a little over a month, we found the sweet spot that actually got us to a place where we felt really good about being able to distribute, the 21% where we landed. But again, every month, no one has a crystal ball. No one knows what's coming next. But we heard from income investors how important it was to really try to get to an income distribution cadence that is relatively consistent. And so that's the method that we have. And the other thing too, though, is like with option premiums that are collected, because we're a 40 Act product, we have to distribute 90+% of whatever is collected from an income perspective that's realized. All the options income is realized capital gain is how it's categorized. So we must distribute it over that period of time before the end of the fiscal year. So the goal is to we want to distribute all of it, but we want to do it in a consistent way. And that's the balance that we're trying to reach.
Okay, with that said, theoretically, the MAG 10 is going to go up and to the right over time, which is going to give you share price or NAV growth just from holding the underlying. Will you ever shave some of that off to make the distributions, or is that an untouchable basket?
It's very, so again, it's a total returns related method. So there are potentially months where if you want to create a consistent distribution, and let's say the market rips up and the option premiums there aren't as juicy as they were in prior periods when the market is going down, VIX is up, for example, you can have months where different components are used to actually give you that consistent income stream. So that is very much something that's on the table. And if you think about it, how do you, it's like a shock absorber. Like when things are going up and down, what are the things that you're compressing and expanding in order to create a smooth ride? That's one of the variables that's available to use in order to deliver that.
So would it be fair to say that you took a look at the first 27 days worth of trading since the time of launch? You extrapolated that out and you said to yourself, Sai, what do I think this fund can pay on an even keel basis over an extended period of time based on what's happened, based on the back test, and you kind of landed on that 21% number?
Yeah, we did that. And we looked at it too from a broad set of, from a lineup perspective too. So we said TMGN, it probably 20 to 24 is like a little window. 21% is a good sweet spot. But think about it from the lineup perspective. We want to create products that have that balance between growth and income. What that means is we don't want NAV, obviously you can't control markets going down, but we don't want to over distribute from what's actually generated by the financial vehicle driving it. So for us, we said, if we're going to do anything, let's start a little bit more conservative for something that is meaningful. It fills a void in the marketplace with a 21% potential distribution. And the lineup actually fits really well too, where T-SPY, we're getting market-like growth of the S&P 500. That's 14% of historical distributions. TDAC, we're getting NASDAQ-like growth, and we're able to distribute 17% tax-efficient distribution. TMGN, 21% fits really well, depending to sort of help satisfy different groups of people that may want different levels of income, but doing it in a very consistent way so that NAV hopefully doesn't erode over time and that we're able to support that level of distribution sustainably over time. So that's really the full picture of it is really sort of where we landed, why we landed where we did.
Okay, 2 more structure questions, and then I want to move on to zero DTEs. So my structure question is, you wrote the prospectus, or whoever wrote the prospectus wrote it where you're going to be equally weighted on the underlyings. In the last conversation, you said you didn't want to be a stock picker and you didn't want to do those things, which I completely understand. But in reading the information about the CBOE fund, The 10 are set in solid outside of like 4 different criteria. One was like a CEO going to jail, it going bankrupt, it being bought out or merging with somebody else, which means that it has a tail risk of one of the companies like Meta today, settled its lawsuit for 17 billion. I mean, you're taking the tail risk of basically having a company in the Mag 10 really not do well because the CBO said they're not going to replace it unless those things happen. They reset their 5 that are on the sideline every quarter, but they won't replace it in the 10. Is there either a thought process or an idea that you might adjust that prospectus for that kind of doomsday event where, Facebook is, or I don't mean to pick on Facebook, but any one of the Mag 10 companies really is like in trouble, that you can underweight that and not have us as the shareholders not have any choice about being in that except maybe exiting your fund?
Yeah, we've got flexibility in how we actually build the basket. We wanted to keep it in line with CBOE and let them be the ones that drive the index. If they're from a timing perspective, and CBOE said that they may change this, the biggest thing for them for compliance is they don't have a committee that actually decides who gets put on and taken off. And the committee structure is a whole different compliance game for them to have to get qualification to release the index. So then for us as an ETF issuer, as long as we can collateralize the option chain in a way that stays within the bounds and the constructs, we have flexibility in what we can actually deliver from the equity side. But again, it's really important for us to own the real equities. But if there is something that says this is probably not going to be best for investors, we do have flexibility in the future to make changes as long as we can continue to collateralize the option chain that we're writing. And one of the unique things about this is, the formula of holding real equities, but trading an index option. That unique connection, I think, is really what we want to sort of be able to support over time. And we can actually collateralize that in a number of ways and still trade the options that we're trading and get that tax efficient income generation. So long-winded way of me saying, yes, there is flexibility. Out of the gate, we're sticking with the monthly rebalance with the index that CBOE's put out.
Okay. And for those that are scoreboard watching, at 208.80, so still a nothing burger, in case anybody's wondering. All right. With that said, so what you're saying, and I'm putting words in your mouth, so slap me around if it's wrong. But what you're saying basically is you believe that you'll be able to trade this fund even if you ratchet up perhaps the risk a little bit more, so that you're not batting 1,000. Because as somebody who's hiring a trader, I'm not sure I want them batting 1,000. From that standpoint, I want them taking a little bit of risk. That's why I'm giving them the money, but not a ton. From that standpoint. But what you're saying to me is I should be able to look at the Mag 10 and receive about a 20% income from that, with the idea of being able to choose whether I want to accept the notional increase of the index, or I want to take the income that you're providing.
Yep, I think that's well said. Very well said.
Excellent. All right, I like that. I think as I explain it to other people at my Dunkin' Donuts kind of coffee time, I think that'll be easy to explain. So the next thing I wanted to hop over to, because there's been some debate and some questions about this, is the trading. So you chose very specifically, and I know you've gone over this before, so we don't have to go really in depth. You chose the 0 DTE as opposed to the night before, and not accepting that notional overnight exposure or extra premium, and being able to have the flexibility. Do you think you can explain that to our audience just one more time so that they understand kind of why you think that's the best way to go?
Yeah, and I'll start with the options are very powerful and you can solve lots of problems with them. The problem that we're solving specifically is growth plus income in a balanced way and delivering that income tax efficiently. So that's our frame. When I think about that, my whole, and folks that know my story, was I wanted exposure to the underlying indices. So in my case with T-SPY, I was like, I want S&P 500 exposure, and I don't want to sell away 30 days of upside and just to get some income today, because I could leave a lot of upside on the table. So I was looking for a solution that gave me that upside exposure and where I could capture most of it, or if not all of it, but also create this meaningful income stream and have those two things live together. And the reason was I stumbled upon 0DTE in October of 2022 when the S&P was down, but I had bills to pay and I was transitioning out of an old, my prior company to a new one, and I didn't want to sell my shares, deal with sequence of return risks in order to actually create that income. And so that's where 0-day options were the perfect fit in my, from my perspective, in order to deliver that additional dimension of income. And the reason is 0-day options they have three characteristics that make them a bit of a different animal than longer dated options. The first one is one you sort of alluded to. 0-dated options you can actually have in place for only the 6.5 hours of the trading day. That means overnight, the long positions upside is uncapped. Weekends, it's uncapped. And that's the biggest knock that you always hear about covered call strategies is, oh, if you're doing a covered call, you can never keep up with the underlying. But if you're uncapped, and I did the math, 81% of the calendar week, your long positions are uncapped if you're doing a 0-day strategy, because overnights and weekends, that's the majority of the time. So that's meaningful. The second thing was if you think of delta risk, the premiums that you get paid, it's significantly enhanced if you do a 0-day option. And the way I explain it is, if I wrote a 30-day option at a 25 delta and I get X dollars in premium versus I write a 25 delta option every day for the 21 trading days, 0-day, and I added up those 21 premiums that you would get at the same delta risk, you would be left with 4 to 4.5 times the option premium potential. So that's powerful, as long as you are able to manage the gamma risk, which is how fast delta moves. So that was another really attractive thing for what we were trying to solve, which is adding this meaningful income stream. And then the third was just the most intuitive one, I think. You just get more at bats. You get 21 chances every morning to reset your strike at a different level based on the latest information and based on what the market's doing. Versus if you're writing a 30-day option, the decision you made 28 days ago or whatever, it's based on stale information. It's a stale position. Versus with 0-day, you get a fresh option every morning, which you just have more flexibility to try and keep up with the underlying. So those three characteristics made it a no-brainer for why 0-day options were the best way to deliver what we're sort of defining as growth plus income investing.
All right, before we move on to the next question in this segment, Wolf, a great friend of the channel here, has a question. What happens to the 0DT options if the market goes to 23.5 trading?
It's a great question. The short answer is nothing, and I'll tell you why. Because 0-day options, they don't just expire on a given day, they expire at a given moment in time. So the ones that we're trading will always expire at market close every day. And what we're really doing when we're trading 0-day options is we're maximizing our ability to take advantage of what they call theta decay. And options expire much more quickly right before their deadline, and that expiry actually happens at a particular point in time. So the existing option chains will be the same. What it does is it potentially enhances, because now you've got maybe an overnight where the open can happen maybe at 8 p.m. and then it'll expire at 4 a.m. the next morning. So it's another bite that you could take overnight. I'm a little bit hesitant to participate in that out of the gate for two reasons. One, we need 24-hour trading. And so we would have to find a team to do that. But two, the historical growth and gains, 66% of the upside of the indices that we're tracking happen overnight. And so I don't necessarily want to cap that in exchange for an additional bite of income. So I think it's all good things. It's just more optionality in the marketplace. It's not going to take anything away.
Okay, and then the last question in this segment is your sub-advisor, as well as kind of the hot topic, or not hot topic, but the hot flavor of the month is, as with the NFL, it's a copycat league, which means ETFs, it's also a copycat thing. It's trying to make sure that you take advantage of what people are looking for right now. The hot topic right now are put spreads. put spreads along with owning the underlying. You already own the underlying. You've shown a great capacity to trade. I know a lot of retail traders that look at a market each day will make their choice. Today, I'm going to do put spreads. Tomorrow, I'm going to do call spreads. Why are you resonant to kind of embrace another kind of weapon in your tool belt?
Yeah, I'm curious actually about it, and actually did some deep studies on put spreads and how they work in comparison to calls, just the vanilla calls that we have. And the main difference for folks to understand is it really comes down to beta. So our one thing that's kind of like we're really proud of seeing it, but when you do a covered call and you're able to keep up with the underlying, but your beta goes down, you're lowering the risk in a way because you're hedging with a call, but you're still delivering the outcome that you want. And so that's a really powerful combo, one for investors, because you don't have to take more risk in order to get more returns. You're taking less risk, getting market equivalent returns, and you're creating income. So that was one attractive combination if you look at the risk, and there's other metrics to measure risk with Sortino ratios and things like that, Sharp. When you do a put spread, it's interesting because you're actually increasing your beta. So instead of a 1, it's maybe a 1.15. And when you increase beta, it's effectively acting like leverage can act. And so I was like,
Wait a minute, did you just say put spreads are effectively acting like leverage?
I said put spreads from a beta perspective can, act like leverage. And I've seen the debates online.
I know. I'm sorry. I had to pipe in there for a second.
I know, it's great. And I'm not, none of this is religion to me in any way. Like I'm just more of a math scientist guy to be like, how does it behave? And put spreads behave like leverage can. And so I actually did the comparison of like, if I did a put spread with the variability of an option book versus if I actually just did like a 1.15 leverage, and paying for that leverage at, OBFR plus some margin, which performs better over time. And they were like bang on, like almost identical. So for me, I was like, if we can get edge by doing put spreads, that makes a ton of sense. Or would it make more sense just to actually lever up the underlying, get the extra 15%, and then you'd end up with the same sort of upside as long as you can access the income piece in a tax efficient way. So I think they're both powerful tools to put in the tool belt, but it's just really important for people to understand the behavior of them and how that impacts the risk you take for the reward you receive. And so we're not, we don't have a preference one way or another. We started to say, especially on the advisor side, advisors really want managed risk. They want less risk with, market-like returns. That's a sweet spot for the advisor market. Retail folks maybe have a little bit more appetite for more risk. And if you can take more risk, you can get more reward. So it's the other side of the same coin ultimately, and what the tools you use. I can tell you, like in bull markets, like put spreads they're just less difficult to manage because markets aren't pushing up against your number all the time. So there's just a trade-off between the two. I'm really excited to see that there's new innovation coming, but it's just really important for people to understand the mechanics of the underlying and what that means for people's risk and what that means for the outcomes they're going to get.
With your lift products, is that kind of what you're doing with the added leverage to the holding and continuing with the overlay?
Yeah, that's the idea, is basically saying if you have a little bit more risk appetite, you're bullish ultimately on the underlying exposure. This is a very natural way to get access to the added potential returns, just in a very straightforward way. Versus like if we were to do a put spread strategy directly, I would call it out very clear to say we're doing this, and one of the reasons we're doing this is because we're trying to create cost-effective leverage in order to add an income component to it. So that's how I would position it, but there's just two different ways to skin the cat.
Okay. With that, I guess the next question that I have in this area is, do you see that as something that you would write into a future prospectus, or you're just going to kind of keep it the way that you have going right now, humming along?
Yeah, open to figuring out if there really is, if there's an outcome that we can solve in a better way with a better set of tools. Like I'm all for it. or a different set of tools. And what's interesting is the tooling that we have, it operates identically on the put side, just like it does for the call side. So we could do it tomorrow. But for me, as an engineer who is like got this reflex to want to solve things immediately and like with the newest best way, I always tamp myself down just to say, hey, what is the problem that investors need to solve? And is this the very, very best way to do it with the tools at hand? So that's the way that we're looking at it. And so over time, it's absolutely something we're open to. And I really want to hear from folks to understand like what is the problem that would solve that existing capabilities don't. That's our sort of lens.
And of course, my good friend with the name Degenerate in his title there wants to know if you've already filed for a lift on TMGN.
We have not yet filed for lift on TMGN, but we did file for T-Russ. I saw that second half, and I've gotten that question of like, when's T-Russ coming, which is the Russell version. We sort of are in the same boat where we want our little bird to fly first with TMGN, get it stable, get it solid, get it in a spot where from an asset perspective, it's going to be here for the long term. And for us, that's the $50 million marker. And I think as soon as TMGN gets on its feet, hits 50, that's going to be the release point for us to then be able to put some firepower behind getting T-Russ out into the market.
Yeah, there's been multiple we want T-Russ in the comments there, just so you know.
Love it. That's great.
So my next question is, and we don't need to sit here very long because I know it's probably not the most interesting question for the general community, but I want to know, what does the partnership with the CBOE entail? Is it costing me as an investor any money? And what doors does it open down the future?
Yeah, it is a really neat sort of connection with them. So we licensed CBOE's brand and their name, so that we actually are able to use their name in the title of the fund. So it's the TappAlpha CBOE Magnificent 10 Growth and Daily Income ETF. With that, we had been in a lot of conversations with them because we wanted to find a very effective way to use their new 0DTE options chain. And so I think we're the only ETF issuer out there that has a licensing agreement with them. And what's really neat about it is it's opened the door as we're building the momentum behind TMGN. And we're at, I think, about 12 million in assets now. We trade 237 contracts, which is like the biggest single, I think, holder of trading MGTN underlying options. But it cracks open the opportunity to do future collaborations with CBOE. And our whole piece is, hey, if there is a need that investors have, let's say, man, I really want something that is non-correlated to US, large cap equities, and say blah, let's say it's ex-US. Is there a way that CBOE can actually create those short dated option chains in order to give us the exposure to create that same formula between them? So I think there's a lot of those conversations that are created now because of this initial partnership or licensing agreement that we have with CBOE. To your question, yes, it does cost investors from a perspective because we've got to license that, the use of CBOE, their brand, their marketing, and those pieces as part of the package. And so you see that the management fee is a little higher for this one. Part of that is the cost of a CBOE licensing partnership, and part of it is also the cost of what these larger retail brokerages are now charging ETF issuers. So you've heard now about a couple of the big ones now taking direct fees from ETF issuers in order to be offered on their platforms. That seems like that's the new model for them. They're taking the all mutual fund model and putting on ETFs. And so as a small issuer that wants to continue to innovate and grow, it's got to come from somewhere. And so part of it is that's where you see the fees growing, especially when we're getting new funds sort of up and running. So that's the reality these days. I'm all for fighting the fight. But ultimately, like, there's a lot bigger players, I think, that can be effective in helping us do that. We just need to figure out the best, we want to do what's best and find the most efficient ways to deliver the products for investors. And so we found ways to actually lower costs by using different packaged ETFs where we lower the cost of T-SPY and TDAC because we used a lower cost underlying ETF to get exposure to the NASDAQ and the S&P 500. So we're always finding ways, we're trying to find ways to do what's best for investors. But I think us being around and continuing to scale hopefully will be the broader thing that will be good for our investor base over time.
Yeah, and as D Squared just pointed out, NVIDIA just popped to 218.
Oh, so, there we go.
There we go. Okay. With that said, and this is, I always throw in one question that I want to know. Have you talked to institutional investors about TMGN? Because it is really a brand new product, meaning it's the Mag 10 index on the CBOE just came out this year. It's not something anybody else is doing. The zero DTEs on top of it. Have you talked with institutional investors? And if you have, what is their response to you been?
We have talked to sort of the RIA channels, and it's been interesting because there's twofold. The thing that they're like, "Whoa, this is really interesting," is the tax efficiency piece of it, and then getting exposure to a set of equities that many of their clients want to own, but those equities they don't really pay you to own them. So that angle and the tax efficiency piece is really attractive. When you start to get, and this is a perception thing from traditional advisors, when you put a 2 handle on distributions, that's when, people are like, how are you sustaining that? And we can explain that through it, but that's where the luxury of time will come in. So folks in communities like the ones we're talking to now are always the lead adopters, because you are smart, you understand the mechanics, you can get in and you actually see how the things work. And as that momentum gets built up, it gives more confidence to the more conservative advisor groups. But all the components and ingredients, it's something that is very interesting to folks because no one has actually done this to date. And so many people have exposure to those underlying 10 names.
All right. I'm hoping so, because not only do I want you to have great success, but I want us and you to be able to launch more products so that we have a wider range of choices. All right. So the next one is something that I want to ask you about from a standpoint of just your theory behind it, because the community has started to get used to and has a taste for weekly distributions. And my understanding is that mechanically it's not that much different, especially since you're doing zero DTEs, than distributing monthly, except perhaps expense of doing it. So I'm very interested in your reasoning behind it, why you keep kind of holding the investor community back from the weeklies and are sticking with a monthly cadence.
We are solving the weekly problem on 2 axes. The first axis is we have 2 series now. We have the Core Plus series, and then we have the Lift series. The Core Plus series, we have monthly pairs across the board, but we're actually staggering the distributions to be on different weeks in the month. And then when T-Russ comes downstream, we've got 3 pairs now on week 1, 3, and 4. We can have T-Russ, and then we'll basically have monthly pairs, but one that's paying every week. So you get effectively a weekly distribution in owning the lineup across your portfolio. And then the second piece was we solved the directly weekly problem by creating the Lift series, where folks wanted 2 things kind of in concert, which was 30% more exposure and then weekly distributions that scale up with the funds in the Lift series. So we're very supportive, I think, of that idea for the reasons and the why that has been explained to us. But we're keeping symmetry across the 2 series, Core Plus versus Lift, and that's how we've sort of solved it between both fund families.
So what I'm hearing you say, getting through all that great kind of like side the politician and making sure that you're answering the question without coming about it, is basically saying that it's going to stay monthly, and the chance of getting a weekly distribution with, say, TMGN or T-Russ or T-Russ Lift is probably not going to happen.
T-Russ Lift, so Lift series are all weekly direct.
I'm sorry. Yes, you're rounded right. But with any of your regular funds.
The reason, and I'll tell you why, the regular funds, the Core Plus funds, they're used both by retail and by institutions and advisors don't want it. And the reason they don't want it is because it's more overhead for them to manage that. For, let's say they have 100 clients that now have weekly distributions. It is now, you have 52 weeks that you have to manage this for 100 clients versus you have 12. And so that's one of the key pieces of friction, is if we have products that advisors use weekly, is going to be really challenging for them to adopt.
All right. Well, at least you said it. I really enjoy the fact that you were transparent with that. Thank you so very much from that point of view. All right. Do you have outside of the 50 million? Is there another kind of table or template that you use as far as launching funds?
What's next? So, and the why, I love sharing the why behind it. 50 million, it covers the operating costs of the fund, and it is actually an unlock gate where once you get past 50, then you have broader audiences for adoption. So the 50 kind of checks a couple boxes, and that's why it's a really good point before you end up launching other funds. And the other thing for us too, we're really intentional about these graphics are really awesome, by the way. I gotta figure out where you're getting all these made. But the other kind of component behind it too is we're not a spaghetti at the wall type of ETF issuer where some will release, 20 funds in one go and then see what sticks. We're very intentional and deliberate because we want every single one to solve a very direct problem, and we want it to be here for the long haul. And so the best way that I know to do that is to go top down, problem first, and then launch these things in a very, very deliberate way to make sure that we're meeting the needs, and then we can continue to scale and grow. And the other thing that I think is super unique about what we're doing and building at TappAlpha is we're not launching lots of different strategies to try and scratch different itches. We effectively have one strategy or one outcome, which is growth plus income. And we're using one technology-based system to run all of the funds. And why that matters for investors is because when we add a new fund, the data that gets fed back in every day makes the other funds that came before it stronger, not weaker. And that's why we do funds one at a time, because we start to expand the data sets that are being put in, and the decisions that are made get tighter and tighter across the existing funds as well. So we're really building a platform approach to solving those problems with different exposures. That's why we do it the way we do. And 50 is a really powerful inflection point because you get a lot of data that kind of comes in and helps strengthen the foundation.
All right. With that said, in the kind of whiteboard or the engineer coat that you wear, how are you considering down the road creating kind of basket or thematic ETFs that would be able to use and or add to like a universe that TappAlpha has? And if so, would you be trading on those particular equities that you'd be holding in the thematic? Would you be trading on a already established ETF that holds the underlyings, or would you perhaps hold a basket of underlyings and trade the Qs on the 0 DTE to create the income, and while holding the underlyings for notional upside?
Those are all great combinations. And my proclivity is to move closest to the formula that we have now. And so the way that we're approaching bringing products to market has been really like big to little. So we started with S&P 500, then we went to NASDAQ, then we went to the MAG 10, and then we're going to the Russell. And so those are big sort of portfolio pie components that people can use. Then thinking about non-correlated assets, so we're sort of going big to little. And then the other piece is, all right, when you're putting together this growth plus income where you own real shares and then you're trading options, I love the tax efficiency and just the execution efficiency of having an index option that we can use that's correlated closely. And to your point, let's say you own a basket of stocks. Our conversations with CBOE say they're open to maybe a core thematic option that could marry well with a themed basket that you hold. So that might be a really interesting way for us to do product development as well. And then if that is not possible, but there's something that is really popular from a theme perspective, we could collateralize QQQ options with that theme. You just have to be a little more careful because it's not nearly as efficient because those things don't actually collateralize one-to-one. You have to stay within this 80% guardrail. And if you go out of it, because maybe the market rips one way and then your options have a different value, then you could get into margin call situations and stuff like that. So we want to keep that as tight as possible for collateralization, but you hit it exactly on the head. If it's not possible, it's still something that wants to be done. There are other possibilities to actually deliver just that.
So you're saying perhaps if you believe there's enough demand that you can go to the CBOE and say, hey, let's create a space index where there are 15, 10 space companies that in that area, and let's create an index for it, and then you would be able to do the same thing you're doing with TMGN.
Yeah, I think we've had kind of conversations, and they signaled that they're open to it. And some of the themes that kind of came up were energy related, AI infrastructure, big themes that as you think about the use cases for them, and that's where the input is really helpful for us. Where in your portfolio does it live? What's the outcome that it helps you achieve? And is it something that is broadly usable by big audiences that kind of match the things that you need? And if all those boxes are checked and we feel that demand, we absolutely have great relationships there to bring some of these things to market. That when we first started, I guess it was 3 years ago since the company was founded. T-SPY just had its 2-year birthday last week. It still blows my mind how much has happened in such a short amount of time. But in those 2 years, we built really strong relationships with the institutions that has been just a real blessing, because we can now build some of the crazy stuff that we're thinking about, and a lot of the stuff that your subscribers and communities are giving us feedback for. We now have a conduit to go and actually talk to institutions to help make it happen.
Yeah, I imagine a day, at least for my own benefit, in theory, is that I'm able to have a complete kind of portfolio of the different themes that I might want to have: metals or rare earths, space, health, energy, and then have you trading the overlay on top of it, so I don't have to wake up in the morning and do that. I gladly pay you the 1.25%, because I know that in trading the dailies, you can generate 14 to 28% without really kind of breaking a sweat. And then if I can have my thematic with the notional upside that I think is there with that overlay, then I've created a entire portfolio that makes me sleep very well at night.
I love it. And that's a beautiful, I think, kind of end goal for us to think about too, is those types of use cases for exactly the way you articulated it. And there's one question I have for you too. The accounts that you're using, and I think about this from a tax perspective, does tax efficiency matter a lot to you, or is a lot of the resource that you have in qualified accounts where the tax implication isn't that impactful?
I would say for me, I'm probably not the norm, but the tax is nice. But I also could just put it into, I have a business account and pay differently and have the write-offs and resources of a business. So I'm not sure I'm the right person to ask, but I would think that the tax advantage is something that the retail trader is not as tuned into, because they haven't been doing it for years and they don't really understand that difference. I explain it like this to my young friends. I said, you buy a home, and if you pay 2% on your real estate tax, basically in 22, 23 years, you've actually paid the government the full price of your house, right, on top of everything. So those little tax things built up over long years do make a difference. But I think initially from a retail investors, it's not like the key thing that I think the issuers think it is, because they have a wider or a broader look at it. I think it'll make a difference down the road, but when I'm comparing the two and I'm looking at 8% or 18%, I don't think the 8% that's yelling tax efficiency is catching the interest as much as the 18% would be in the retail space.
Got it. And that's a good way to frame it too. And that was one thing I learned the hard way. I was doing this stuff before the ETFs were available in my own brokerage account, and the tax impacts of trading 0-day options, it was tough because everything was actually treated as ordinary income in my non-qualified accounts. Versus when I did it in the ETFs, you're seeing this constructive return of capital tax mechanism that is only available because ETFs have this in-kind create redeem capability that individual investors don't. And I did the math for myself, and I compared same identical returns projected over time, apples to apples. But in the ETF versus in my brokerage account, I was left with, over 10 years, 47% more after-tax capital. And that, for me, with a retirement timeline, was a game changer to say, I'm going to stop doing this strategy in my own individual account, and I'm just going to use my own ETF products because of that factor alone. So something to think about, but it's a really good lens to put on it to say, maybe it doesn't matter as much to retail folks. And so just want to make sure that we're able to describe that in a way that's going to resonate.
Yeah, and as soon as I said that, I had 4 comments in there saying that it mattered a lot to people. So don't take what I say as gospel on any level at all. All right, we've been on for more than an hour. As always, I'm very grateful for you and your time and treasure and your clarity, and also with the transparency that you speak. Anything that you want to share that I may have missed today that might be important to you, maybe about the other funds, about something that's coming up that we haven't talked about yet? What would you like to talk about?
I always come back to it, and these conversations are my favorite. I really appreciate also talking to you directly, because you're super informed, you're very articulate to make really hard topics kind of manageable to talk about, and you're such a good conduit for input from the communities, and that to me is the most important thing. I've been getting just unbelievable input, emails from folks in support of what we're building, and it's 2 things for me. One, it's energy and juice that makes the hard days a lot easier, because it's not easy kind of doing what we're trying to build and deliver, but it's so worth it because of the input that we get from the community. And 2, like you just articulated, the use case and the why, and what is the problem that we're trying to solve. That stuff for us is gold, because that will help us find the best way to get tools to investors to solve those problems. So keep those coming in. The input for T-Russ, the input for TMGN, those are things that have informed our roadmap decisions. The Lift series, that only came about because of input that we've gotten directly from the community. So just a huge thank you for it. I really feel like we're building this stuff together because of those interactions, and just know that I'm a resource for you. If you come and send emails through TappAlphaFunds.com, I'm still the one that always responds to those every day. And honestly, it's my favorite part of the day. So just thank you for your support, your interaction, and just really enjoying building the stuff together. And who knows where all of us are going to be in a year, but the goal is we want to have a lineup that really can make an impact on people's lives directly. And that's why we're here.
Well, I know where we should be. When you cross $1 billion, we should be on a TappAlpha cruise.
Let's go. Let's do that. We'll bring swag for everybody. I'm in.
All right. Okay. I do appreciate it. If you could stick around just for a moment when we're done here, just a couple things to run across with you. For those who are watching, whether you're watching right now or on a recording, I'm just so glad that you spent some time with us. And I hope that you learned something today that's valuable and will help you moving forward. And I just pray great blessings and prosperity over your life, in your relationships, with your family, with your children, in your jobs, with your finances. May it just be amazing. Until we talk next time, pow, pow.